Welcome everyone to this explainer. Today we're going to decode the seemingly invisible paper trail that literally keeps the entire business world turning. And to make this really tangible, we're going to follow a specific story. Meet Dr. Ruhi. So after years of working in a massive hospital, she's finally taken the plunge. She is opening her very own independent clinic and pharmacy. It's a super exciting time. But, well, beneath the surface of treating patients and stocking the shelves, there is this massive, absolutely vital web of financial paperwork that she has to master. Today, we're going to use Dr. Ruhi's journey to understand exactly how business source documents work. Here is our roadmap for today. We'll start with how the paper trail begins, then move right into paying the team, compare invoices versus receipts, navigate returns and errors, look at internal tracking with vouchers, and finally end with the final bank deposit. Okay, let's dive right into this. Section 1, the paper trail begins. Before Dr. Ruhi can even unlock the front doors of her brand new clinic, she has to understand the golden rule of business. And it's this: every single financial move needs proof. No exceptions. And that proof is exactly what we call a source document. It is the original, authentic, documentary evidence that verifies a business transaction actually happened. It's not just a note hastily scribbled on a napkin over lunch. It's the rock-solid, verifiable foundation of all accounting. Because think about it, without these documents, an auditor has literally no reason to believe a transaction took place at all. So let's look at the toolkit of documents Dr. Ruhi is going to be using every single day. Each piece of paper here serves a highly specific purpose. For instance, a cash memo is generated when goods are sold for immediate cash. An invoice, or a bill, is prepared when she sells or buys on credit. Then you've got a receipt, which is the formal acknowledgement that money has actually been received. There's the check, a direct order to a bank to pay a specific sum. The pay-in slip, which is the form used to deposit cash or checks into the bank. And finally, debit and credit notes, which, as we'll see, are absolutely crucial for handling returns and errors. Moving right along to Section 2, paying the team. Let's look at wages versus salary. Obviously, Dr. Ruhi can't run this entire clinic alone, right? She needs to hire nurses, receptionists, pharmacy staff, and that means she has to figure out compensation. Let's clearly contrast the two main types of pay here: wages and salaries. This is a really crucial distinction. Wages are variable. They're based entirely on the hours worked, and crucially, wage earners are eligible for overtime pay if they work beyond standard hours. They are often part-time or contractual workers. On the flip side, a salary is a fixed amount. It's paid irrespective of the exact hours worked, usually reflecting full-time employment, and comes with benefits like health insurance. But because it's fixed, it is generally exempt from overtime. And this brilliantly illustrates how we actually track those variable wages. It's a standard wage register. Notice the columns here. For her wage-earning staff, Dr. Ruhi has to meticulously track the number of days worked, the rate of minimum basic wage, and specifically the overtime hours worked. Because wages fluctuate so much, this specific source document is absolutely vital. It ensures everyone is paid fairly and legally for the exact time they put in. All right, Section 3, invoices versus receipts, knowing the difference. So the clinic is officially open for business, and as Dr. Ruhi buys her clinic supplies and treats her patients, she's going to be dealing with invoices and receipts constantly. Now, people often confuse these two, but I want you to think of them as an ongoing conversation between businesses. An invoice is issued before payment. It's effectively asking, hey, will you pay me? It requests money owed, what accountants like to call accounts receivable, and it is a mandatory document for calculating GST and tax liability. A receipt, however, is the answer to that question. It's issued after payment. It confidently states, I have been paid. It confirms the money is actually in hand, serving as undeniable proof of income and keeping the whole business ready for any kind of audit. Let's demystify what an invoice actually looks like in practice. Right here, we can see a formal sales or purchases invoice. Notice how it's laid out. It's very logical. We have the buyer and seller details clearly established right at the top. Below that, there's a clear description of the goods. In this specific example, it's sandals and slippers, but for Dr. Ruhi, this is exactly what she receives when she orders bandages or syringes. It lists the unit price, the total amount, and any trade discounts applied. This isn't just a memo, it's a formal, legally binding request for payment. Which brings us to Section 4, navigating returns and errors. What happens when things go wrong? Because let's be real, in business, things do not always go perfectly according to plan. So let's introduce a little plot twist in Dr. Ruhi's journey. We're going to walk through this timeline step by step. On day 1, she purchases 9 lakh rupees worth of medical supplies on credit from a supplier named KK Industries. Great.
But on day 3, she unpacks the boxes and discovers that 1 lakh worth of those supplies were completely crushed and damaged in transit. By day 4, she sends the damaged items back and issues what is called a debit note. And on day 5, KK Industries receives the broken goods, accepts the return, and issues a credit note right back to her. Notice what didn't happen here? Not a single rupee of actual cash changed hands, yet their accounting is perfectly balanced. So how does that work?
Well, the crucial point is how these two documents work together like a perfectly choreographed dance. A debit note is issued by the buyer, in our case, Dr. Ruhi. She uses it to notify KK Industries that she has debited their account in her books, effectively reducing her payable liability. She's basically saying, hey, I no longer owe you that 1 lakh. In response, KK Industries issues a credit note. Issued by the seller, it notifies the buyer that they have credited her account in their books, reducing their receivable asset. They are saying, we agree, we will not expect that 1 lakh from you. These two notes perfectly mirror each other to fix the discrepancy in their ledgers, totally avoiding any messy cash flow issues.
Section 5. Internal tracking with vouchers. Let's look at internal accounting.
Now we've got to look at the internal housekeeping Dr. Ruhi must do to prepare for her accountants and auditors. We've talked a lot about source documents, but how does that raw paper turn into actual accounting? That is exactly where vouchers come in. You see, a source document records the raw external details of a business transaction, like the physical receipt from the store. But a voucher? That's an internal document. It is supported by the source document, and it acts as an accounting translation. The voucher contains the actual accounting rules, telling the bookkeeper exactly which account is to be debited and which is to be credited. So while a source document just records the event itself, the voucher is designed specifically to verify and categorize that transaction for the auditors. And just so you have the full picture here, Dr. Ruhi will use 2 main types of vouchers. Cash vouchers are, well, exactly what they sound like. They record actual cash flowing into and out of the clinic. Simple enough. But she also needs non-cash vouchers, which are sometimes called transfer vouchers. These are absolutely critical for handling transactions where money hasn't moved yet, like when she bought those supplies on credit, or when she logged the return for the damaged goods, or even when recording the depreciation of her really expensive medical equipment over time. And finally, Section 6, the final bank deposit, securing your funds. Let's move to the climax of the whole business cycle, shall we? This is easily the most satisfying part of running a business, securing your hard-earned money. What we're looking at is a standard State Bank of India pay-in slip. This is the ultimate source document used to physically deposit cash and patient checks into the clinic's bank account. Notice how it requires the date, the account number, the exact breakdown of cash denominations, and the specific details of any checks. The bank keeps one part of it, and Dr. Ruhi gets the stamped counterfoil as her undeniable proof that the money is safe and sound in the bank. The paper trail is complete. We have followed Dr. Ruhi all the way from defining basic documents to managing payroll, handling damaged goods without exchanging cash, creating internal vouchers, and finally banking her profits. It really is an intricate, beautiful dance of documentation. So, I want to leave you with this provocative thought to ponder today. If an auditor knocked on your business's door today, would your paper trail tell the right story? Remember, organized source documents aren't just annoying red tape. They are the absolute lifeblood of a successful, stress-free business. Thank you so much for joining me on this explainer, and keep learning.